zero DT options. Every Thursday, our market measure for the last probably 2 months has been on zero DTEs. And today, we asked the research team, based on just so many emails that we get about zero DTEs, what to do about SPX butterflies. Okay? Let's take a look. Today, we're already out of the range.
With volatility upticking like this, maybe that's something you want to look out for today. Either side.
Well, finally, you're going to get them a little cheaper. Butterflies are going to trade cheaper when implied volatility is higher, and we're already outside the range for today. Way outside.
Way outside the range.
Yeah. A 1 day implied
by two to three.
We've moved
2 times.
I mean, if you want to know why I use a butterfly as opposed to a naked position, today's a perfect example because we moved. We moved a lot more than the $30 expected move. We've already moved 60. So 1 day implied volatility of the SPX gauges the premium of the zero DT options. It has declined by 75% from its peak in mid-March following the Silicon Valley Bank crisis. So volatility on volatility, I'm sorry, the 1 day VIX, let's take that back. The 1 day VIX, which reached a peak of almost 40 back in the Silicon Valley, dropped into the, into the low, the under 15. So we've basically been sliced by two-thirds, 3/4, 1/2, whatever you want to call it. It doesn't matter. I mean, if you want to go average to average, we're sliced by a half. If you want to go high to low, we're sliced by 75%. Whatever the case is, there's a lot less juice now than there was. You got to be careful. When do you have to be most careful? In periods of low implied volatility. Let's go next slide. High implied volatility, very few outliers. Low implied volatility, lots of outliers. Over the last 2 months, the SPX closed within its average zero DT straddle price just 51% of the time. Now, if you risk one to make one, does 51% of the time sound that crazy? The answer is probably not. This means that the zero DTE game has become a coin flip at best, which we have suggested from day one. Zero DTE is essentially a coin flip. Risk one to make one, 50-50% probability of profit, and the actual number over the last, what do they say here? How many days has it been? 2 months is 51%. In March and April, the SPX closed within.
So they have to be full loss or full profit either, right? I mean,
no, that's true. Yeah.
Okay.
So
the net money can be different.
In March and April, when the volatility was significantly higher, the SPX closed within its average straddle price 61% of the time. We did much better in zero DT options in March and April because the cost of butterflies were cheaper and we had a higher percentage of closing. When volatility is really cheap, it's harder, not easier. So what we did here, the first piece of research we threw out here was expected versus realized. So we did between March and May, and then between May and July. And you could see the average SPX zero DT straddle price before the market opened was $20 in March and May, between March and May, and then between May and July, it was $30. And then the percent time of the SPX closed within the average straddle price of the day went down to 51% as volatility dropped and was much higher before that. Let's go next slide. That's a pretty big move. It's about 20%. So is there a way to return to the higher probability zero DT trades? How can we adjust our existing $30 wide SPX butterfly in this lower IV environment to get the pop a bit higher? Like, is there a way to get the pop higher?
Of course there is. I mean, it's going to involve taking a little bit more risk, but of course there is. I mean, one simple way we'd be doing is making like a broken wing butterfly where you embed a little bit of a short spread in there.
So you think that is your key, Mr. Batista?
I mean, I think taking more risk is the key, sure.
All right, let's take a look. So we looked at the SPX. We analyzed the following strategies: a $30 wide iron fly, a $20 wide iron fly, an iron condor with wings $10 and $20 wings. I'm sorry, with short wings $10 apart and $20 wings, and an iron condor with short wings $20 apart and $20 wings.
All right, so they're sticking more with the butterfly iron condor strategy.
Yeah, we're sticking with the defined risk. Okay, and we compared the following metrics: the probability of profiting 25% of the credit received, and the ratio of max loss to profit, meaning 25% of the credit. All right? All right, let's see what we got. There's going to be a lot in here. All right. Because implied volatility is so much lower, and this was, obviously we did this piece before today, but because implied volatility is so much lower, we could narrow our wings without sacrificing much in pop. Lower ratios are better because they represent the number of profitable trades that cancel out a full loser. So we looked at here, and Pat, you're gonna have to
Try and
figure this out. We did the iron fly, which is sell the straddle by the wings, and
$30 wide, $20 wide. The probability of
and then we did the iron condor, $10 a par, $20 a par with $20 wide wings. All right, and we looked at the probability of making 25% profit and the max loss as a ratio of that 25% profit. Now let's see if we can decipher anything from here. So the probability of profit when we look at these kind of trades at 25% is pretty damn good. Okay, but the max loss. Go back one slide, Beth, for 1 second.
3.2.
I just want to get the right definition of max loss. So the
Ratio of max loss to profit target of 25%. So they were either taking a profit target of 25% or a max loss.
Yep.
So you reached max loss 3.2% of the time. I'm assuming that's what they're saying.
Let's go to the next slide.
Before you were able to take the credit of 25%.
Yeah. So 3 times you
would want that number to be as low as possible.
As low as possible.
Right.
Yes.
Right.
And so that
so the iron fly with $20 wings is really you give up 3 percentage points, but that you
well, in this case, the little bit tighter on both the iron condor and the iron fly.
In low implied volatility. Now, if you have volatility where you have today at 17 and or above, you start getting a lot more implied volatility. Those wings are going to be a lot more expensive. These numbers would change.
Let's take a look. Let's go to the next slide. So iron condors are a tougher trade despite their pops approaching the 90% range when managing aggressively. Placing your short strikes a few strikes from the at the money makes your ratio higher, taking up to 6 trades to make back 1 loser. Okay, so yeah, you're right about that. So even though the probability of profit was higher, because of the ratio, it just took way more times to get back to even if you had a max loss.
Because the game's played by and the score is kept by how much money you get to keep. And
of course.
Right. If it costs you too much to get it back, then it's
Let's go to the next slide. So by narrowing your long wings on your iron fly or your butterfly, you can reduce the ratio of risk while maintaining your P25. That's P25 is what are the probabilities of getting to 25% of max profit. So if you can keep your P25 but lower your ratio, okay, the winner for this whole thing was the iron fly with the $20 wide wings, which kind of doesn't surprise me, but I guess there's a part of it that I guess probably does, because I wasn't thinking that's not the trade I was doing. But now that I see this research, now it makes total sense, because looking at the probability of profit being virtually the same. Basically, what they're saying is when you have a big move, you can't control it anyway in zero DTs.
Right.
So if you don't get any move at all, you can control that. So you're better off with only requiring fewer times to get back to your number. So that's really interesting, is that the $20 wide wings outperformed the $30 wings simply because you got back to you got back to your profitability way quicker. Okay, cool. Let's go to the next slide. So with implied volatility drying up, we can just adjust our zero DT trades to be in line with the lower expected moves. By narrowing the width of our zero DT butterflies, we can reduce the effect that a max loss would have on our zero DT trades by roughly 40% while maintaining our probability of scalping a profit. We could also trade an iron condor, but try to keep the short wings closer to the at the money. So the bottom line here was, whatever you do, narrow everything in a little bit in low implied volatility, because when you're wrong, like on a day like today, it doesn't matter.
You're wrong in a big way. There's nothing to do.
Right.
Yep.
And when you're right, you still keep that same probability of profit, that same pop.
Very good, sir.
It's pretty interesting. because that will change the way I trade some of these zero DTs.
Oh, beautiful. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with Oh Joy. Mr. Scott Scherer next, Tasty Trade World Headquarters.